Thank you, Clement. Thank you, dry bulk panelists. Thank you, Peter Allen.
Yeah,
Great
thank
work.
you.
All right, see you later. Okay, we're going to zoom in for a one-on-one, in focus, Jim Cirenza leading the way with Joakim Hannisdahl, founder and CEO of Gersemi Asset Management. Jim, are you ready to roll? Okay.
Ladies and gentlemen, so today we're going to find out how to make some money in shipping. Many of you know Joakim as an analyst for a couple of different firms before he decided to launch Gersemi Asset Management back in 2023. Congratulations on your year-to-date results so far. He's up in the teens year-to-date in a long-short fund. And so we'll pick his brains on a few subjects. But first, tell us a little bit about the science behind your investment approach.
Thank you, Jim. So the science is, I've always been kind of curious exploring different ways to do things. I always thought to myself that the standard way might not always be the right way. So a little bit on the background. I've been investing in shipping for more than 20 years. I started in the industry in 2011 in Nordea Markets as a junior shipping research analyst. And I came from university and had an extended master's degree in econometrics and fund management. And I came with all these ideas into the industry. And I thought to myself, this is cyclical. This is perfect for econometric approach. But I was met by a feedback from then my senior analyst that this was not a good idea. I shouldn't talk about it because people will laugh at me. So I thought to myself,
you might actually have a short idea once in a while.
So I thought to myself, maybe there's something here. If people tells me it's a bad idea, I kind of thinks, it kind of ebbs me on. Anyways, so I did the junior part of the career building, changed the seats a couple of times in equity research, and I started to employ these econometric models across all the different shipping segments. And that was back in 2014. I started to employ them. I was in kind of between jobs, and I was put on a quarantine by the previous firm. So I had a couple of months on my own. So I started checking out the econometrics, and it worked really well on the backtesting. So I started employing them and looking at the forecasting and I ran them for a couple of years as an analyst. And they were working extremely well. I think basically close to maybe 80–90% hit ratio, as long as there's not a black swan event, a big demand shock. That's always hard to predict, right?
And we're not having any shocks in the market lately.
No, it's been calm seas. Yeah. No, so that's when I became ranked #1 shipping analyst globally, or in Bloomberg. It's based on recommendations and not how many lunches and dinners you're able to have in one quarter. So that was quite nice. And then investors started to approach me saying, hey, instead of you giving us investment advice, why don't you rather take our money and employ it, and we can set up a fund. So that's many years ago now. It's a little bit too many years. It takes a lot of time to put together a fund structure, but that's where we are now. We have been running the fund now for 2 years, and it's been a decent story so far.
What else do you think gives you an edge in terms of your investment approach?
So the backbone of the fund, the strategy, is the econometrics. It's our ability to forecast the medium to long term in cyclicality of the business. So you have supply, you have demand, you have inertia on supply, you have a highly responsive demand side, and that makes for cyclicality. So that's good. What we have experienced since managing and since inception is that we can add so much more or so much value by doing short-term investments. Surprisingly, a lot of value doing short-term investments. So how we perceive it is we are currently kind of at the apex of the information pyramid. So we are getting all this information from beneath. We have a lot of experience. We have many years of experience knowing what data points are important and what's not, because more than 99% of data points are unimportant, right? And we have everything set up in-house, so we are kind of a hybrid analyst and portfolio manager. So we have everything in-house, all the models, and we have an extremely efficient investment decision process. So, for example, last Friday, when we in Europe woke up and we have seen all these events overnight, we know basically exactly what to do. We're ready when markets open. We do have the FFAs trading from early morning. So we're able to then turn around our portfolio extremely quickly at that pricings where we perceive it's a good opportunity, even though the information is known, it's not yet 100% priced into the market.
Let's switch to your fees. Tell us about your fee structure.
So we have a 220 fee structure, but what kind of sets us apart, and I got a lot of flack from the financial accountants on Ireland for this really intricate way to set up the fee structure. So in a normal year, the investors pays us the performance fee, we waive the fixed fee, and we also cover the operational cost of the fund. But in a year of non-performance, we need the fund to cover its own operational cost, and we need that fixed fee to keep our lights on. But it does an implicit hurdle rate of 10% and higher.
Let's jump to corporate governance and how that fits into your investment decisions.
It's something we'll look at, definitely. We are always kind of looking at what's the rise price of the company. For companies with a good management, a good capital allocation, and a history of investor friendliness, we do have a propensity to pay above NAV. But for companies with another kind of a negative sign in front of all those items I just mentioned, we don't have the propensity to pay above NAV. We need a discount, and I think that's also very well reflected in market pricing. So what we do is we do the fundamentals, and we then apply it to all our company models. So we basically have the same inputs for everyone, and then we have the same valuation matrix for every company. So we're able to compare each company between each other. And then we do capital allocation based on which company is most favorably priced. But we do add a layer, a subjective layer, based on governance. So if a company with inferior governance is cheap enough, we pick it up. But everything has its right price. That's our approach.
Let's talk about capital allocation and how that impacts your investment decisions. So that's question number one. And question number two within that same category, shipping had a pretty tough decade from 2010 to relatively close to 2020. Shipping doesn't have a long history of distributing dividends to shareholders. Is the history for shipping distributions too short for investors and analysts to look at it in any other metric other than priced NAV? So two questions there.
Yeah, so capital allocation is key, at least at peak cycle. So how we view it is trough cycle, NAV is the most important metric. So you want to get in at cheap asset values. You want to get in on a discount to the cheap asset values. So you're basically buying below, hopefully, historical lows. And then as the cycle matures, then you are really looking more at earnings multiples. Yield is very important. We prefer commodity shipping. I know there's a lot of industrial shipping that might be able to kind of smooth out the cycles and be able to have a sustained dividend for a long period of time. We prefer commodity shipping. We expect you not to have been paying dividends for the last 70 quarters. That's okay. That's what we expect. But when we invest on the trough of the cycle or the expansionary phase of the cycle, if we get it right, we want to get rewarded. So the worst case scenario for us is getting everything right, employing capital, and then when you're at peak cycle, you don't get rewarded. You don't get the capital. That's when we want to get the money out. We want to decide if we want to buy more shares, like a share buyback. We want to decide if we want to buy more vessels or if we want to move that capital into another segment. Because you have arguably 6 distinct shipping segments. And we want to be moving between them. They don't correlate. So being stuck in a peak cycle company and earning a lot of cash but not paying it out, that, I mean, the market is telling the truth. It's a big discount to NAV and earnings multiples versus peers.
Let's spend a moment on correlation, because lately they seem to be correlated, but maybe it's just because the events are so dramatic. Talk about how different the cycles are for a couple of the segments that you look at.
Yeah, sometimes you have a few of these kind of broad drivers, like hydrocarbon exports from the US has been driving several segments and so on. But yeah, they're highly different. And right now we're long oil tankers. We do see that we are at peak cycle. I mean, it's quite obvious. But right now we have an oversupply. So oil tanker earnings are driven by a supply of oil, not demand of oil. So we can have an oversupply for a couple of years, have inventory building, and that's a good period for tankers. We do see increased demand or increased number of barrels coming out of the Atlantic, basically right around now. So we do think that's a good second half of this year event. And then you have OPEC Plus having increased their production quotas quite aggressively. And those barrels are likely hitting the sea after the domestic consumption season, which is probably around September, October.
I know you're on a panel later today where you'll talk about specific favorite ideas, long and short, but let's get into your investment ideas right now by sector, long and short, and your thinking behind it.
Yeah, so we're long oil tankers, but we have seasonally taken it down a little bit because we saw seasonally rates coming down. But we retained a lot because we want to be long in the second half or into October. And also there's all these political events. And most of them are favorable tankers. So we didn't dare take all the chips off the table as we could have done in a normal year. We retained a lot of our longs. And now last week, obviously that was in hindsight a good move to retain a lot of chips on the table. And our other kind of main thesis at the moment is in car carriers. You have had a fantastic cycle, but now you still have, or you have a lot of supply growth coming. Demand growth is kind of under question, and also you have key risks being opening of Red Sea, and that could be detrimental for car carriers. And also the last kind of segment I would like to highlight is containers, where you see a lot of the same drivers as car carriers. You have had more supply growth already, but it's been sustained by the disruptions from the Red Sea. And it's we think we are probably not seeing a reopening or normalization near term, but regardless, it looks really challenging after this seasonal high season. And then if we get a reopening, it should be, or it could be, really painful for both car carriers and containers.
Getting back to the tankers for a second, what would be the news-wise, what would be the worst-case scenario for tankers?
Opening a Red Sea for product tankers. That's kind of why we have our main exposure in crude, also due to the barrels in the Atlantic. But again, the product tankers are very cheap at the moment, so we do have some skin in the game there as well. But I mean, if Europe were to begin taking Russian oil again, if you trade Oslo to Antwerp rather than going to India, that's going to be a big negative for oil tankers.
So you touched earlier in terms of how you reacted Friday morning. Talk about your speed of execution and why that's an edge and how important that is for your performance.
Yeah, so we're constantly bombarded by news and coming from the markets, coming from fixtures, coming from every part of the world. But now it's an added layer of geopolitical news flow, and it's constant and it's both ways. So it's very hard to be, like what our strategy is to be proactive, foresee the cyclicality, employ capital, and then kind of have a medium to long-term view. What we have been doing much more now is being reactive to news flow, but then it's extremely important, and we see how important it is to be very light-footed and agile and having everything in-house. So whereas potentially a US generalist needs to have a call with an analyst, have an investment committee meeting, and then make an investment decision thereafter, we can make literally decisions in seconds. It's we just get together, start shouting between the offices, and we get together in front of a screen, and we do the investment decision, and we have everything in-house that can trickle through all our models in just a second.
So take us quickly through last Friday morning. Did you start buying shares in Asia?
So my colleague Frederick called me early, and he said, "Hey, Joakim, have you seen this?" So I just got in the car, got into the office. Frederick was already there, and we started working the FFAs. And then Oslo exchange opened, and we started working the equities. Then we had the predetermined plan. We have the threshold where we feel, given the new information, given the change in risk-reward, where is the fair pricing of each equity in our universe, and then we execute with limits towards those prices, and then if prices then goes beyond, we're done.
We've only got time for one more question, so I want to thank Richard Diamond for the next question. What are we worried about today that we shouldn't be? Number one. Number two, what aren't we worried about today that we should be?
It's two good questions.
Thank you, Richard.
No, so I think we should be worried. I mean, the world is in disarray. It's chaos everywhere. So I think we're looking at pricing of investment instruments. You need to have a much higher risk element into your consideration, and so the risk premium is obviously much higher now than a year ago. But I think in terms of the geopolitical risk, what we have seen in the past is shipping is quite resilient and able to absorb a lot of punishment, to put it that way. And also a lot of these disruptions are very positive for shipping, like the invasion of Ukraine, Red Sea, all those kind of things. So the market might be a little bit pricing in a little bit too much risk, but again, it's no right answer. The proof is in the future, right? And what we should be concerned about, what we are concerned about is we are concerned about new building prices. Everything is kind of contingent on new building prices staying elevated. So when we do our in-house models for asset pricing, it's basically based on replacement cost, which is new building pricing, and it's based on the earnings power of the asset. Right now, we have return on capital employed of around 5% in dry bulk, around 8% in oil tankers. I mean, that doesn't really get us excited. The reason asset prices are so high is because new building prices are high. That's a good story as long as they're high. But that's also one reason we focus much more on yields at the peak cycle of oil tankers, for instance. So we look at the order book, the forward cover of the order book, and year to date, deliveries have been higher than new orders. It's a concern. So that's kind of our main concern at the moment, and something that should be getting more attention than it is.
Thank you very much.
Thank you, Jim.